Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
Welcome, everybody. Chris Seveney with Seveney Investments. And today I wanted to talk to all of you about our quarterly update from 2024, second quarter. Talk about what we're seeing in the marketplace, talk about overall performance, and where we see things headed within the next quarter as well as in the next year. So for those who do invest with us, proud to say that we've been able to issue a distribution for 23 consecutive months. This July, we are hitting the 2-year anniversary of our Regulation A+ offering, CWS Investments, where we have grown to over 670 investors, with a significant number of those investors actually reinvesting within the fund. So for all of you who have invested, I just want to say thank you. Our fund does continue to raise money, and as we're raising the money, we have not had any challenges to date in deploying funds into assets. And for those who received the report, what's interesting is, a question we get asked all the time is, what's the size of the market in mortgage note space? How much do you see? And I remind people that the mortgage space is a $13 trillion industry, on just 1 to 4 family. And then that doesn't even include, seller finance stuff and so forth. So you think about $13 trillion. And in any period of time, there's hundreds of billions of dollars in non-performing loans. And give people a retrospect. And the second quarter of this past year, we saw over $5 billion in loans come across our desk. I'll say that again, 5 billion, not 5 million, 5 billion. And of that, 5 billion, approximately almost 20% of that were non-performing loans. It was just under $900 million in non-performing loans came across our desk. And when you think about that, if somebody would acquire 10% of that, that's 90 million. We are more closer to, less than 1%. Typically per quarter is what we are looking to acquire. Now, interestingly enough, second liens are making a strong comeback. There was over $100 million in second liens, and also other types of loans out there, again, that make up the scratch and dent, qualifying, non-qualifying, bridge loans, which are like fix and flip loans, were out there as well, and non-conforming, which is higher dollar value. So each one of these had a specific piece of the pie. Non-performing, when we looked at all the categories, was one of the top next to, I'd say the non-conforming type of loans that we see come across. So when you think about it again, $800 million in non-performing loans in the last quarter did come across our desk. Now, with that, how did that shape our portfolio? What does our portfolio look like? Currently, we have 66 assets in the portfolio, which is slightly down from the prior quarter. And the reason being is when we started 2 years ago, for those who have, followed us on our podcast and listen, the churn is typically about 18 to 24 months. So when we were getting started and had a few $1 million, the loan balances may have been lower to diversify that portfolio. And those loans who've now been working them out, we've turned around and started to liquidate them. And, early on, our average loan balance was, 100,000, 80 to 150,000, whereas today our average loan balance is over $300,000. And the property that is secured by our portfolio is average asset value is almost $1 million. It's 66 million in asset valuations. And that is something we continue to be very strict on, is making sure the assets in our portfolio have that equity in them, because I see prices softening. And I don't want to have a $300,000 loan on a $350,000 property. That's not going to end well in my mind. Having a $300,000 loan backed by whether a $500,000, $600,000, $700,000 or higher $1,000 property, gives us a lot more comfort in regards to if we see any type of softening come across the market. It allows us to be able to work that loan and make sure that we have that cushion to protect our investors' investment. Preservation of capital. One of the things that you probably hear me harp on a lot is, we want to make sure we're always that preservation of capital. Why? Because if you look at all the other investment strategies, or I shouldn't say all, many of the other investment strategies out there that take on leverage, which we don't have any right now within our portfolio, interest rates have gone up and they've run into some serious issues, not only on the returns they were trying to target, but even that preservation of capital. And I've seen investors, people I know personally, not only get wiped out of their investment, but got the double whammy where they had to go back and basically pay additional taxes because they took accelerated depreciation early on in the fund, and now they have to pay that back. So we talked a little bit more about the portfolio and where we spread out. Currently, we're in 24 states across the United States, and we're primarily east of the Mississippi and south of New York is where the primarily majority of our assets are. As we start to shift towards the west, we've got some assets in Oklahoma, Nebraska, Arizona, Nevada, and California. But basically anything from, I'll say, Wisconsin, Illinois, west above kind of that median, we don't have assets. You don't see much in Idaho, Montana, Washington, Oregon, the Dakotas. But it's an area that, we typically also stay out of, and primarily because there's not a lot of activity. And to build a team within that area, an attorney and, REO people, if you have to take it back, is a little more challenging. So sticking to, the 25, 30 states that we typically will play in, we feel gives us diversity in regards to several factors. One is, I believe the real estate market, if there is any type of softening, is going to start in specific markets. I think we're starting to see that in certain areas of Florida, which I've recently seen somebody who bought a property to fix up, thought it would be worth $600,000, it's only worth $4,000. Now they're underwater, they're getting foreclosed on. I think you'll see some of that in certain markets. So we want to make sure we're diverse and not all in, I'm just going to pick Clearwater, Florida. This first thing that popped in my head, whether that's a good market or not, we don't want to be everything in Austin, Texas. So another location that, is it okay to have assets there? Yes, but we don't want a majority of our portfolio to be spread throughout one specific region because, I wish I could predict the future. I wish we could shake my little magic 8-ball or whatever the case may be. Actually, I have a fidget spinner somewhere on my desk. Hold on. A little fidget spinner here that says no tomorrow, sit on it, yes today, pass the buck, maybe, all that fun stuff. But one thing I think I love to do is analyze data. We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. And kind of see the ebbs and flows of where the data is headed from things. And The New York Fed, with Consumer Credit Panel and Equifax, recently produced a pretty significant report that I've done prior recording on. And really what it talked about is looking at it right now, transition into delinquencies by loan type. And it goes back to 2003. And as you can imagine, the economy after the dot-com bust, delinquencies early on in the 2000s, and for those who were not around or too young, the economy was actually doing really well. So delinquencies started to drop a little bit, except for student loan debt, because college started to get really expensive. Thankfully, I graduated before then, and my cost of 4 years is about the cost of 1 year now. So things started to drop. And then in 2006, believe it or not, people think it was like 2008 or 9, but 2006 is when that delinquency rates really started to pick up. And we're talking credit card, auto, mortgage, and home equity. And all of them followed the same pattern between 2006 and essentially 2011. They peaked around 2010, and most people know end of 2008, beginning of 2009 is really when, what started hitting the fan, but it just didn't happen overnight. That continued for a significant period of time. And, through 2010, 11, those are still great times where people could get into assets at a very low price because everything was dropping significantly. And to give an idea, mortgage delinquencies were typically on average between 3 and 5%. It peaked over 12. Credit card peaked up to 14, which credit card is typically about half that. So everything basically doubled from their norm. Thankfully, things settled down and things pretty much stabilized back from 2013 to 2020. Credit card debt floated, right around the 6%, auto loan about 7%, mortgages were floating around about 4%. So everything, student loan was about 10%. Everything was kind of just floating across the ocean with some little bits of waves up and down until, of course, COVID came. And student loan, let's take that off the table because nobody was defaulting because they didn't have to pay. But everything started to drop during COVID through 2022. Why? I believe because the government printed about, $7 trillion. And you really didn't have anywhere to go out to eat. You couldn't go on vacation. It was hard to spend money. So what happens when consumers have several years of pent-up demand? What happens? Fear of missing out, want to keep up with the Joneses. Everyone starts going out and buying stuff, buying real estate, buying cars, buying NFTs, buying Bitcoin. Everybody's just buying whatever they think is the next hottest thing. And that will last for a period of time, but eventually I think it's going to pop. And this report is basically showing, credit card debt or defaults transitioning is up around 9%. And it is like literally in the span of 2 quarters when it doubled. It went from 4% up to 9%. The incline, only time it was steeper was in 2008. Auto loans are actually, again, those went from about 5 to 8. The increase of auto loan delinquencies is actually faster than it was in 2008. Mortgages have gone from about under 2 to up over 3%, not as steep as 2008. Now, one of the things that I think is helping mortgages is people filing bankruptcy, because then when you file bankruptcy, technically your loan is current. So that information's not in there. But I share this because, and I apologize for getting so technical, this trend isn't unexpected for us with rising interest rates, inflation, housing market dynamics, property values fluctuating, unemployment, which is starting to pick up. And honestly, I do question what the true, unemployment rate is. The increase in defaults, they're at all-time lows or were at all-time lows. There's only one place they can go to get back to normal and stabilize. They got to go up. So what do I think? I think in the short term, which is the next 1 to 2 years, delinquencies will continue to rise as borrowers adjust to higher interest rate environment, economic conditions, poor spending habits. Now, this trend could be mitigated by government intervention if the economy, I think, worsens significantly, but I'm not sure how the government will intervene, and I actually don't think they probably will. And typically when they do, it's usually too late. And the other reason why I think we're going to start seeing this is, I don't know if people saw this report, but Bankrate came out and did a cost for a typical single family and hidden costs over a course of a year. And it was mind-blowing because it's $18,000. Think about that. $18,000 of hidden costs. Now, what does that include within that cost? One is insurance on a property and taxes. So those can range significantly. I'll tell you right now, our tax bill went up. So I'm in Fairfax County, Virginia, which Virginia I think is pretty good for property taxes. I used to live in Massachusetts, so I'm just comparing. But we still went up, I want to say around 10% in property tax. Our homeowner's insurance, we were at a number that went up by more than like 200% was the initial estimate we got. And then we started picking up the phone and calling other people, but it still went up by about 25%. When you think about that, that's significant cost where people struggle, or when people get a mortgage that, they don't leave $300 to $400 extra a month for taxes, insurance, and some of the things that can pop up. And I just want to remember this $18,000 is when you look at $1,500 a month, and that's on top of the mortgage, which is the most expensive all time ever. So things that you need to understand is it's getting a lot more expensive. And again, insurance is probably one of the major factors because it's something that you can't cut annual premiums. You can't do much about that. So it makes it that much more challenging. Now, other things that are included in this, energy bills. Again, cost of energy is everything with inflation gotten out of control. So that's something that also got added to this factor. And that depends on state, where some people may have $100 a month energy bill. I know places like in the Northeast, if you're using oil and the cold, that can get extremely expensive. And again, this $18,000 is just an average. Places like Alabama, $12,000 versus places like California, $28,000. And they also compared this from 2020 to 2024. Most states are up by 20 to 30%. So we look at everything's getting more expensive. I don't see wage growth at 20 to 25% to account for everything that people are paying. And when people say, inflation's 2.5%, honestly call them BS on that, because I know my costs go up more than 2.5% per year, even though I know it was like 9%. I think that 9% year was probably double that. But again, I'm not an economist. I only can look at what we spend and look at how much more things look to cost. But I share all of this outlook because it's also good to, again, go back to where we started, is what do we see and where do we see the fund going? And we see the fund, moving in that direction of, we're going to see more opportunity out there, and more opportunity for us compared to a lot of the other real estate sectors is interesting, because in the multifamily space, which I know a lot of investors like to invest in those type of assets, are not seeing significant opportunity, or there's significant risk associated with a lot of that opportunity. Other types like self-storage or short-term rentals, same thing. They are experiencing so much cost that it's challenging to bear. Whereas as a note investor, we don't own that real estate. So the cost of the insurance, the cost of the taxes, yes, they impact how we bid on assets, but we're not burdened by those costs when we're buying a non-performing loan. We only get burdened by them if we have to take it back, which, rewind, we have a $300,000 loan balance on an asset worth more than twice that amount. It's rare that we would take it back because it would sell at auction. So hope that gave also some insight into our thinking, our logic, how we're strategizing and game planning for the future. And for people out there, these are, great questions to ask people of, how are you strategizing, or other, opportunities? What do you do? How do you strategize? If this, then that. So great things to ask. I hope you enjoyed this market update, this quarterly update for Seveney Investments. If you have any questions, please feel free to reach out, invest@Seveney Investments, and we're happy to answer any questions you have. Thank you all, and take care. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.